But tonight we are happy to have the gang here from Spartan, and I'm going to turn things over to Ryan Gibson to run through. We asked them just to come on and kind of give a state of the union of their portfolio and just how things are going in their world, to just touch base in this crazy economy that we're dealing with and everything else. We ran into them at BEC a couple weeks ago and asked if they'd be interested, and Ryan was very excited about it. So Ryan, I will turn it over to you.
Thanks a lot, Chad.
Absolutely.
Thanks so much, and we really appreciate Left Field Investors for having us on. And tonight we're gonna talk about everything about Spartan. Some of the left fielders don't really know about Spartan, so I'm gonna talk about what we do and what we've done and where we're going and where we're headed and why we like self-storage as an asset class. But really appreciate the team for having us on tonight, and we're gonna jump right into it. So welcome to the State of the Union for Spartan Investment Group. My name is Ryan Gibson. I am the Chief Investment Officer and co-founder here at Spartan. And today what we want to do is just walk through our State of the Union. So what's happening in storage? What's happening with interest rates? How is our portfolio performing? What assets are we selling? What assets are we keeping? A lot of the occupancy trend data. And rather than hear it from me, I actually have two of my team members coming in from the field to talk directly with what they're seeing with interest rates and operations, which I think are going to be the two most critical things to focus on during this uncertain time. So as we jump in, I just want to head off right away that we are not planning on having any capital calls in the portfolio. We don't plan on making any additional calls for assets in jeopardy or any facilities. So wanted to get that out right away. Obviously, in any investment, everything is subject to change, but from this standpoint, where we sit with occupancy and our comfortableness with the balance sheets, we have no capital calls planned for assets in distress or anything like that. Second thing is that we feel very comfortable with where we are with our balance sheets. Every single investment has its own operating reserve and sort of rainy day fund, so to speak. And we feel very comfortable with that, with our balance sheet positioning today. And that's largely due to how we've capitalized each investment, with every single investment outside of the DFW portfolio being a fixed rate interest on our investment. So our next loan doesn't mature to 2025, and so we have a lot of runway with fixed rate debt, which is really going to protect us in this rising interest rate environment. The second thing is that portfolio-wide, we have increasing occupancy trends. So despite what's going on, our best performance has been in the last couple of months. Our occupancy is increasing at portfolio-wide. The DFW is seeing over 100 net positive move-ins for the month of March alone to date. And so we're actually seeing really good trending data, and we haven't even hit our lease-up season, which usually starts after Memorial Day in the self-storage industry. And lastly, our value add strategy is working. So we spent a lot of what we bought in 2021, we spent 2022 deploying our value add strategy, meaning that we were buying assets, we were painting them, we were paving them, we were putting in drive aisles or putting in better security, getting our arms around a lot of assets. In 2021, we purchased 29 facilities in Q4 alone. So we spent the latter part and the most part of 2022 fixing up those assets, hiring and training the right teams, and really getting our value add strategy deployed. And so now we're well positioned for lease up and for increasing occupancy for those assets, specifically in the Boardwalk portfolio and the DFW portfolio and the Spartan Storage Fund 1. I talked about fixed rate debt. This is a big deal. I think right now a lot of investors on the top of their mind is, where are we at with interest rates? Do you have variable rate loans with rate caps, or do you have fixed rate debt? And there's a lot of uncertainty out there with investments that have variable rate debt. And we're going to cover that tonight. We're going to dive deep into it. I don't want to cover that now, but I'm actually bringing on Thomas Eddy, our VP of Capital Markets, to talk specifically about SVB Bank, where we're at, how we're standing, and kind of what we're seeing in the lending market. And lastly, we're benefiting from our economies of scale. We're starting to put properties, for example, now we have 4 assets in Chattanooga. We have multiple assets in and surrounding the Atlanta metro area. We're adding assets in Florida. We're we have a lot of our value add strategy and our economies of scale in Texas and so on, and we're starting to see those benefits in marketing and economies of scale and efficiency with payroll. So with that, I also wanted to just kind of touch briefly on what we're seeing in the storage market. We haven't seen cap rates expand very much. We're seeing cap rates go up maybe 30 to 35 basis points. We're actually having our portfolio evaluated by brokers to kind of see where we stand and what assets we should trim off. Most recently, the Centerville location and the Southeast portfolio sold for about a 4.2% cap rate. That facility is a Gen 1 facility in a very tertiary market, so you can tell that self-storage values have held up very strong. And we're also selling some of our lower quality assets, trimming some of our portfolio like the Seagoville location and the DFW portfolio. We're very close to having that under contract for sale. Boat Club Road, we're actually selling that asset in this quarter, and we have that very close to being under contract. And then the Front Range portfolio, both Aspen Park and Devonshire, we're selling those assets at a very attractive cap rate, at a very good value for our investors. So we're selling assets right now at peak pricing. So when you think about the self-storage space, values really have not come down all that much, if at all. There's not blood in the streets. There's not a plethora of good deals out there. It's still very difficult to find sellers willing to accommodate the rising interest rates, and self-storage is holding firm. So part of the reason is because self-storage over the last 28 years has been the best performing asset class across all major asset class types. And we've shown this slide to you before, but if you haven't seen this, ever since Black Monday, 1987, when the markets cratered over 30%, self-storage occupancy was steady. And when we had the dot-com bubble burst in 2000, self-storage occupancy was super steady. The recession of 2008, and most recently the COVID-19 pandemic, where self-storage actually really took off and did really well. So self-storage is a very uncorrelated, stable asset class as an industry, and we've really benefited from that, and our investors will continue to benefit from that for the foreseeable future. And that's because storage is life events. Pure and simple, as the economy gets disrupted or things happen like people need to free up a room for storage, or working out, or having a work from home office, or shuttering a business, or downsizing, or relocating, all these things drive people to use self-storage. So despite where we are in the economy, it tends to do very well, especially during rough times. And we saw that during the pandemic. This is kind of REIT level returns. And self-storage was actually, again, in the last two recessions, the #1 performing asset class out of all other major asset class types. And you can see the performance here. And so where are we today? What does it matter for how storage did in the past? How is it shaping up to perform now? And what we're seeing is we're seeing a lot of money in the space. We're seeing a lot of new faces. We're seeing a lot of new sovereign wealth funds, pension funds, endowments start to get into self-storage even today and get a seat at the table. In 2020, we saw Blackstone get into self-storage. We saw Public buy $3.3 billion worth of it. We saw Bill Gates buy a quarter share in Stormart. We saw Inland Private Capital monetize a big portfolio. But even today, the largest self-storage fund ever put together by the Prime Group, $2.5 billion fund, was just put together in late January. And so you can see that we're really seeing a resurgence, a stacking of capital to go into this space because of its recession resistancy. Wall Street Journal, obviously a few months ago or a month ago, reported Public Storage and its unsolicited $11 billion offer for Life Storage. This kind of speaks to the trends in the self-storage industry where there's rapid consolidation, one REIT buying another REIT, trying to eat up as much market share as it can get because of its confidence in the space. So with that, we see self-storage occupancies remaining strong. The average occupancy last we checked was about 93.5%. We see rates holding steady. We see a return to seasonality, meaning that usually in our winter, Q4, Q1, early Q1, we see move-outs happen, but we see a strong return and a strong leasing season on the heels of Q2. So, we're seeing a solid industry, a very stable investment, and asset values not coming down, which makes it great if you own them, makes it a little bit more challenging if you're trying to buy them. But for those that don't know Spartan, This is our executive leadership team here at Spartan. My name is Ryan Gibson, our Chief Investment Officer. Those are all of our leaders here. These leaders represent the vertical integration nature of Spartan. So you have the three leaders of Spartan, myself, Scott Lewis, our CEO, and Ben Lapidus, our CFO. And then you have Aaron Saunders, who leads our construction company, Matthias Kalmer, who leads our FreeUp Storage property management division. Then we have Whitney, who oversees as our Director of People, Chad is our controller, and then Kevin, who's our Chief Legal Officer. And we oversee a storage portfolio of about 65 properties nationwide, primarily in the Sun Belt, but throughout Colorado, a couple of facilities, some strategic locations in the Midwest, and the Pacific Northwest. And we're actually the 40th largest operator of self-storage in the United States. And like I said earlier, we're vertically integrated. So we do everything from acquisitions to finding the debt, syndicating the funds, and doing construction and asset management, all the way to property management. So, but that kind of brings in a good segue. Self-storage is not an easy thing to finance. More banks are starting to back self-storage. More banks are starting to get into self-storage. But really, 67% of all loans are done by local and regional banks. And so what we rely heavily on is building relationships with lenders, which pay dividends in these challenging times. And we have an entire team here at Spartan in the Seattle office dedicated to finding loans. And the gentleman that heads that up is Thomas Eddy, and he's our VP of Capital Markets. And I have the pleasure of bringing him in, and I wanted you guys to hear from Thomas Eddy on what we're seeing in the market today. And without further ado, I'd like to introduce Thomas Eddy.
Ryan, great to be here.
So a big thing on investors' minds right now is the collapse of Silicon Valley Bank. And obviously, that was a big impact in the banking industry, had a lot of downstream impacts. It could still have downstream impacts. We're still kind of seeing how it all shakes out. But can you kind of speak to if Spartan was impacted at all by this yet?
Good news is directly impacted, no, just because we did not have any deposit accounts, nor have we taken out any loans with them. The ripple effect's still going on, so we'll see what comes out, but no direct impact.
Yeah, we don't have any banking relationships there or any loans, so that's really great. How is self-storage positioned well despite the shakeup of Silicon Valley Bank and other potential banking collapses? I mean, does self-storage have any advantage in this situation, maybe over multifamily or retail or office?
As an asset class goes, self-storage over the last few years has been getting more and more popular. Lenders are more interested in lending on it, and so I think that remains true. And showing that it can be slightly recession resistant, lenders are still very interested in self-storage, and so if they're placing capital, it's a good place to put it.
Yeah, and I think we've heard a lot of instances lately about where investors had relied on floating rate or obtained floating rate debt, creating a need for an interest rate cap or a surprise in some of their investors and that they didn't realize that their underlying deals had floating rate interest rate debt. Can you kind of speak to our strategy that we've always had since the beginning on mitigating risk on interest rates for many, many years?
Yeah, since inception, Spartan's always tried with local banks to get fixed rate loans. And so that means no caps, no swaps needed. You know what your interest rate is, you know what your debt service is going to be, and so you have that long term. And the good news is we have no loans maturing this year or in 2024.
Great. So we're pretty protected from that. I think with the exception of the DFW portfolio, that is the only deal that we have that has a floating rate loan, correct?
That's correct.
Yeah. And can you kind of speak to that loan a little bit? Like, yeah, it's floating, maybe why we didn't buy a cap on it, and kind of where it's at today and sort of some of the stress testing that we put into that deal?
Yeah, so while we don't like floating rate loans, DFW, the spread, meaning how much the bank was charging us over the index, was very low. And so that was one thing that attracted us to it. The other thing was middle of 2022, caps were very expensive because there was so much market uncertainty to where we ran the analysis and it just was too expensive. It didn't make sense to purchase a cap at that time. And even looking forward, we don't see an issue with that rate being floating, even with the perceived rate hikes from the Fed, to where that portfolio is going to find itself in trouble.
Yeah, and where do you think that interest rate is going to end up? Maybe around 7% total. I think today it's around 6.85 6.85 or 6.86, something like that?
Barring recent news, I think we're all expecting the Fed to do about another 0.5% increase. I'm still expecting a 0.25% this week. End rate's probably going to be right around 7.5 on the highest mark.
Okay, great. And so what are you seeing in the lending environment today? Do lenders have an appetite to continue lending to self-storage, or is that kind of drying up, or what is kind of the aggression so far for banks today?
A lot of caution from the banks. Now, they still need to place capital. They're still wanting to make loans. And so where they are making loans, it's typically within self-storage or your typical assets of industrial or multifamily.
Yeah, and speak to our lending relationships. We work primarily with local and regional banks, the bank next door, in other words. Talk about our lending relationships and maybe what advantages that gives us.
Yeah, rather than having one source of capital, one big bank relationship, all eggs in one basket, we've got a lot of different relationships. And so depending on what those banks are doing, we've got a lot of different levers we can pull on or relationships to utilize. So it allows us to get quicker capital and also a faster way to talk to the decision makers. So if it's going to be a no, we can get to that no much faster.
Yeah, and I know that you talk to all of our lending relationships on an ongoing basis too. I mean, what kind of sense do you get from that?
Yeah, I think just hearing from the local lenders, a lot of interest in putting capital out there. They're trying to make loans. There's a lot of requests coming in too, which is why those relationships are so important.
And where are you seeing rates for self-storage? What interest rate quotes are we getting on some of our new upcoming purchases?
The good news is our rates are getting closer and closer to that of the top tier multifamily asset classes. And so, depending on what the lender's benchmarking off of, I'm getting as high as 8.5% quotes, but 6.5 is still obtainable.
That's great. And we'll kind of wrap up with what strategies are you in capital markets doing to acquire debt or finance these assets this year that maybe you weren't doing last year, or maybe a better benchmark would be 2 years ago?
Yeah, a lot of it's just keeping in touch with the lenders and trying to get creative in how you deal structure, because there's a lot of different tools that the bank can pull on as well to get the deal done. Also, Spartan launched a debt fund this year, which is the first time we've done that, and that provides another reliable source of capital for us.
That's great. Well, I just want to thank you, Thomas, for coming on, sharing your insights, all your hard work on getting our loans done last year. Hats off. We financed the entire Spartan Storage Fund 1 deal. That whole portfolio got fixed rate debt, and I believe it was about 5.5%, something like that, fixed rate debt in last year's market.
I think it averaged out below 5.5. So real pleased with the relationships we had and the capital we could close on.
So thank you so much, Thomas, for sharing your insights, and we really appreciate you coming in and telling us all about the debt and what's going on with loans and all the craziness that's happening with some of these bank fallouts. So with that, we're going to kind of move on to the presentation and talk about operations. I think it's most critical right now that you have the right people focusing on building the most value with what you have, especially in today's time where you've got to squeeze every ounce of value out of the portfolio. And Spartan has had this on the top of its mind for many years. So we have been on a search to find someone who has a ton of experience in the self-storage industry, great experience in asset management, and really kind of repositioning a portfolio for the most success. And the gentleman here at Spartan who's in charge of that is named Matthias Kelmer. He just joined us as our president of FreeUp Storage. And it's with great pleasure that I bring on Matthias. He's in our Denver office today, or in Golden, Colorado. And Matthias, welcome, and thank you for joining us.
Thanks for having me, Ryan. Glad to join.
Thank you. And so how many years in real estate have you been working in the space, in storage, and just in real estate in general?
So in general, 20 years now. And I started in commercial real estate from the ground up, really as a store manager or as a property manager, and then went into leasing, ended up becoming an asset manager, and then worked for a private value-add investment firm out of Los Angeles for almost 10 years. And that's when Extra Space found me. They were looking for someone to build an asset management team and also wanted to build out their value-add team. And that was 6 years ago. So I've been in storage for 6 years now.
That's great. And that's a pretty big role, a VP of Asset Management for Extra Space. What did that encompass?
Asset management means different things in every single organization where I've been part of. At Extra Space, it meant setting the asset strategy for the whole portfolio. Think of, as a REIT or Extra Space, they operate over 2,000 facilities. They own outright about 1,000. They joint venture another 300, 350. And the idea is come up with a strategy or a business plan, if you will, for each property. And that means, should we keep it? Should we sell it because it's a bad market or a bad asset? Or should we put in significant cash to make it bigger? That's the value add play, right? I mean, you might have some adjacent land. Let's build more units out there. So that was one aspect. Another team that I had working for me was the joint venture team, maintaining the relationships with institutional investors like Prudential or Nuveen. They own hundreds of these stores, and they want to know for their investors, how are we doing? An example would be COVID happens. They want to know, is that good or bad for storage? What are we doing about it? And then a third team that I had was the non-storage team. So anything non-storage income related reported to me. Think cell towers, billboards, office, retail, and industrial.
Yeah, so a lot to unpack there. I mean, first and foremost, we've been on a search for a president of FreeUp Storage for the last 2 years. We're not just going to go out and hire anybody to man our self-storage platform. And so we went through countless interviews, countless fact searches for a president. And what I think attracted us to Matthias so much was the fact that not only did he have the institutional relationships, the store asset management relationships, but the value add drivers. But the last thing you talked about too, which I think is really important, is in our self-storage portfolio, we end up with a lot of random parcels, cell towers, RV spaces, vacant land, developable land, non-developable land, land that we're going to spin off and sell. And all those things take a lot of horsepower to squeeze all the value that we can out of these assets. And Matthias is really well situated for that. But Matthias, you're a pretty experienced guy, and I'm sure we weren't the only group looking to recruit somebody of your caliber. What attracted you to Spartan and specifically FreeUp Storage?
I was actually looking for, so let me back up. Extra Space, I joined Extra Space, had a great time. Extra Space is a wonderful company. But over the last 6 years, I achieved what I set out to do. I hired the right team, I built the right team, and we had success. And I was ready for my next step. And about half a year ago, I realized that would probably be outside the organization. Started interviewing, started connecting with different operators, different investment shops. And what attracted me about Spartan is the strategy behind the team. It stood out to me that you guys, or us, I shouldn't say you guys, excuse me, rewind. But when I first got introduced to Spartan, I noticed that there was a very clear strategy that you could translate from Scott, from the CEO level, all the way down to anyone in the organization, to the site manager who's collecting cash from a tenant. And that's pretty powerful. That's actually not easily done. And it's certainly not easily done in a large corporation where sometimes you're dealing with lots of different silos, lots of different layers. And that's the number one thing that attracted me to Spartan, but also the value add nature of your portfolio. I think with your 60-something sites, there is a lot we can do.
That's great. And, I think it was almost an instantaneous cultural fit. So we really appreciate having you on board with that. So let's talk about, you talked about, being attracted to more of a smaller portfolio than, what you were accustomed to sort of overseeing at Extra Space. What do you see, kind of, people want value add and these types of value propositions during kind of these uncertain times. But, can you talk a little bit more about our portfolio at Spartan here and sort of where we can take it from here and what value add opportunities that you see?
Well, the first opportunity is we're in a portfolio that is not 100% full. So we have some room to grow in that sense, and that's the number one priority right now. Drive up occupancy. When you get more occupancy, the fuller you get, the more pricing power you have. And that's what we need here at Spartan. We need more occupancy, and it's actually looking quite well. When I looked at the stats from January, February, going into March, and then we're just starting the lease-up season, you actually have a very positive trend, which we're trying to build on.
Yeah, and so kind of speak to that. What's our strategy going to be at FreeUp during these tougher times? A lot of investors are in multifamily, in office, in retail, and their distributions might be turning off, or they may be facing a capital call. And here at Spartan, I think we've done a really good job of keeping our balance sheet strong, portfolio by portfolio, making some good value add improvements at the property. But from an operational standpoint, what is our strategy kind of going forward to really keep building momentum in the portfolio?
Well, I mean, you saw during COVID and after COVID that this is an asset class that is very resilient. Actually, we thrive when others don't. That's a good thing. And going back to my previous comment, we have occupancy that we need to build. And then when I say value add, it means is there space in our portfolio or at individual properties where we can monetize more? That could be an underutilized parking lot. That could be empty dirt that we own next to our facility where we can expand. Or that could even be, let's say, if we have some office space or some retail space that is really in a poor location for retail, well, can we convert that into storage because it's a better use? And that's what we're trying to do with the portfolio. And on top of that, obviously, there's always the growth of bringing additional facilities into our portfolio.
During these uncertain times, how does storage maintain the upper hand for success? And I think this kind of ties to the reason why we're all in the space in the first place, why we love this asset class. But why do you think it's really potentially going to shine for the next 7 to 12 months or for the foreseeable future?
I think more than 12 months. Better.
Yeah.
I'm here for the long haul. Two things I like about storage, or I've even liked before I was in storage. Number one is flexibility. Storage, the type of use is very flexible. And what I mean by that is, sure, I would like to have a nice, perfect rectangle. But if we have an odd shape, we're like water. We can utilize any space with small 5x5s or lockers. We can utilize and monetize space that other uses really have a hard time with. So there's good opportunity for us to always be an answer where other real estate users are not the answer, or where a use from previous times just is not the right answer anymore. And then the other thing that I like about a storage is just the inflation hedge. We are on month to month, and so if you have opportunities to grow rents, we can do that on a month-to-month basis. We don't have to wait for a 3 or 5 year term or 10-year term or even longer. And other asset classes are jealous of that. They would like to be the inflation hedge too that we are.
That's great. And so yeah, Matthias, really appreciate your time coming on, talking about the portfolio, talking about some of our strategies going forward, and really just kind of the excitement that we have and the momentum that we're building in FreeUp. Thank you for coming on and sharing your thoughts on where we're headed.
Thank you. Let's do it again. Take care.
So thank you so much, Matthias, for sharing your insights on the portfolio. Obviously, knowing what's going on the ground and what our strategy is during these times is a really important thing to know and that investors want to know about. So I wanted to kind of conclude the presentation today with what our investment thesis is for 2023, what we're doing, why we're doing it, and what opportunities investors have to take advantage of it. And really what we decided to do this year was take advantage of all the value that's being created. It's very difficult to find property in today's market, but it's also, maybe it might give us an edge to negotiate with sellers a little bit more to find value maybe in ground up development. Mixed with the uncertainty of getting loans. We uniquely created the 3 funds, the debt, income, and growth fund, and these 3 funds are meant to be complementary to building our portfolio and offering investors with specific niches that they can invest in within the self-storage space. So specifically, the Spartan Storage Income Fund, I'll kind of pick on that one first, it has the 3 things that investors want the most: cash flow, upside, and depreciation. So for those investors who are in a deal and they just really want to replace active income with passive income, the income fund is perfect for that. We're only putting existing cash flowing facilities in that fund. The growth fund, though, is for somebody who wants a little bit more upside, who's willing to take on a little bit more risk. In today's market, we're able to find some of those vacant land plays where we can go in and we can develop from the ground up. But we don't want to mix a cash flow investor in that fund. That fund is not for cash flow. That fund is for upside. So that would be for the income fund. And lastly, giving us the certainty to know that we can close loans, we stood up the Spartan Storage Debt Fund. The benefit to investors is that you get cash flow monthly, it's backed by storage, it's a lower risk investment. You either get an 8 or 9% preferred return. So just kind of talking to the growth fund a little bit more. The growth fund, ground up deals, facilities with most value potential, and these are kind of the target returns for the growth fund, 19 to 26%. It's about a 2 to 2.3x multiple over a 5-year hold period. And as we probably have heard in previous webinars, these are investor splits. If you invest in the first 45 days, we've actually given our investors a better benefit. So you actually move up a full share class. So if you're a Class A, you're going to get a better split. You're going to get a better liquidity preference in the growth fund. So what we're going to do in the growth fund really is we're going to look for vacant land where we can buy it, reposition the permits and plans, maybe rezone, re-annex, and then that could be an opportunity for us to sell the land. And that would benefit the investors with a 39% projected return. Or with ground up development, we have the option to build the facility and sell it at certificate of occupancy. And typically that would mean about 100% project level return in 2 to 3 years and about a 79% return to the investors. And then the last option really is to lease up that property, put it into our FreeUp Storage property management company, and have it be stabilized when we sell it, providing the most return in years 3 to 5. So that's kind of our strategy. In the growth fund, we have those unique different exit strategies that we really like, especially in today's market. And these are the types of facilities that we build. We like building from the ground up because you really can get it right from the get-go by building what you want. Income fund, again, this is value add and core plus deals. This is cash flowing facilities, not doing any ground up development or things that drag on cash flow in this fund. Gets the 3 things that every investor wants: cash flow, upside, and appreciation. These are the returns that we project inside the growth and the income fund. The income fund is a 5-year hold, just like the growth fund as well. And again, there's a benefit for investors investing early. These are the splits and the pref. And if you invest early, you get a benefit. You can see it's a 5.5% benefit. If you invest in the first 45 days as an A member, it gives you a 9% overall return better benefit. If you invest as a B, it bumps you up to a C. That all ends on May 1st. Our plan for the income fund is really simple. This is a facility we're actually just about to sell. We fix it up. We put it into our brand standards. We increase the value by bettering the signage and the curb appeal at the main road. We do things like office renovations where we come in and maybe the mom and pop owner has done a terrible job kind of attracting customers and things like that. And we really make office renovations look super nice and clean, just like this one. But lastly, I just wanted to touch on the debt fund, cash flow, monthly distributions backed by self-storage. And this really targets 2 types of investors. One that wants 8% per annum interest in a 90-day lockup period or a 90-day redemption. or an investor who wants a little bit more interest over a 2-year lockup. Both notes go 5 years total, but then you have the option of redemption in the 90-day or 2-year respectively. So where are we going to invest in 2023? Where are these funds locating properties? Well, we really want great locations, high traffic visibility from the main road, well-located properties with opportunities to raise rents and really grow. We want these properties around our other facilities. Good economies of scale are going to drive better results for our investors and better distributions. And you can see here on the map, I've got the little red clusters around where we invest currently. And these are some of the demographics that we look for. These aren't changing. Strong job growth, population, income, economies of scale, and storage demand are really what's going to be successful. So if you want any more information on our funds, Ed Osborne did a presentation on our income, debt, and storage fund earlier. You can go to our website and find that. But I'm here live tonight to really answer any questions that you might have about self-storage, about what we're doing. Really appreciate you tuning in and listening. So with that, we can hand it back and open it up for questions.
Great. Ryan, thank you for that. I like
Yeah,
the
you're welcome.
presentation mode. That works out really well. You guys did a nice production on that too. We will open it up to any questions. You can feel free to drop questions in the chat if you wish, or you can come off mute and ask live if you will. Whatever floats your boat. But anything that you have for Ryan while we got him on the line with us here, any questions that the group has related to Spartan's portfolio and all the changes you guys have been into? Give people
I have a question.
Oh, there we go. Great. Benjamin?
My question would be on the debt that you're doing today. How long are you fixing the rate? How many years?
Typically 5 to 7 years.
And you're finding that available through local bank financing?
Correct.
Okay. And the interest rate range, I believe he said, what was it, like in the 6 to 7% range that you're
6 to
finding?
8%. Yeah, 6 to 8%. Correct.
Okay. And then in terms of loan to value, what's typical that you are shooting for? How much equity are you putting in the deals?
This year, most of our deals are probably going to be bought 100% unlevered, but typically 60 to 65% under normal conditions. We're likely to very low leverage this year because of the high interest rate. We'd rather have the cash flow go to the investors than to the bank. And right now, interest rates being so high for the next year or two, we see an opportunity to refinance at a later date if interest rates go down. But this year, we're planning low leverage. But to answer your question more directly, 60 to 65% is our typical leverage point on a deal.
And because you operate that debt fund, that allows you to find those resources to fund the deal, so you don't have to go to the bank. Is that correct?
That's correct. And the debt fund, the security requires us to collateralize or give a deed of trust to the debt fund of up to 80% of the portfolio, but it's likely that most of the portfolio, if not all, will be collateralized. And that's our debt fund optionality that we're baking in.
Good. Thank you.
You're welcome. Thanks for the question.
Thanks, Benjamin. We did have a couple show up in the chat. Ryan, I can read them off if you like, if that'll work.
Yeah, sure. I can read them too. I'm on here as well.
Okay. Whichever's easiest. Mark had.
Yeah, sure. So Rob had a question. If you can currently get 6 to 8 fixed rate debt on the new deals, why is the same debt structure not suitable for the DFW portfolio? Right now, we're right in the middle of that. So we're getting about 7% or maybe 6.88% was our last month's effective rate. So we are getting that today, but we're in talks with our bank to restructure potentially the debt. And they're a very, very strong lender of ours. When we looked at that loan originally about beginning of 2022 or late 2021, that SOFR rate was a really attractive terms, but unfortunately the interest rate went up. The Fed raised the rate, 4.5%, up from the predicted 1.5%, 1% that was forecast in 2022. But we're looking at restructuring into fixed rate debt. That's very top of mind for us. But our effective rate, to your point, Rob, is about that 6.88%. I'd have to look exactly at what it was last month, but we're hitting those targets today. Mark had a question with the debt fund. Is it behind the bank debt on a property? Is the fund used as collateral, or is it guaranteed by the GPs? Not guaranteed by the GPs. You do get a promissory note. It's a 5-year note. It likely is not behind bank debt, but it could be. But 80% of it has to be collateralized by the property, and most of our lenders are not okay with the second position. So likely it'll be a majority of it will be in the first position. Good question.
All right, I'm on mute. Any other questions out there? Quiet crowd tonight. Yeah, there's another one. I'm going to get the slides from today. So the slides, Ryan has shared them with us. When we get the recording all touched up and send it out via email, we'll include the slides with that as well.
Yeah, no problem.
Anything else? Quiet group.
Yes, we do have. Yeah, so we do have a track record document that I'd be happy to share. No problem at all.
Great.
The question was, do you have any information on past performance for full cycle funds? We do. We can send that out. I'll make sure I get that to you, Chad. You might have to remind me though.
Yep, nope, I can send you a note.
Okay, no worries. I can take a note too.
Yep, that's all right. We'll double it up.
Just in case.
I get it.
Yeah,
it's Monday.
It's also in our deal room. So if you go into our investor deal room, we post our track record in the deal room as well. So good questions.
Yeah. Anything else? Well, if it's quiet and everything else, we don't have to stay on it much longer. We've got 15 minutes left though.
Sure.
Give a couple more minutes. Let me make sure I get my note. Past performance. If not, we can I'll pull Steve Sue in, and Steve can help us with our networking we do afterwards. Yes, thank you, Steve. You just posted it in the chat, but feel free to run through directions with it as well.
Yeah, so to get on that, it's wonder.me, and just click on that link, and the LFI 22 is the password, and it'll take you to that. And it's a little bit different than Zoom if you've never been on it. So you have to actually move your cursor to the nearest person, and then you can actually connect with them and talk with them, and you can have many different conversations, or it can be in one big group or multiple groups. So you also have to make sure you close your Zoom window as well. Otherwise you get some feedback. So, but it's a good way to network, and if you guys want to do that, feel free to go ahead and do click on there for Done with the Meeting chat. I guess we can go ahead and do that. And Ryan, please feel free to jump on too if you like.
Yeah, I plan to join.
A couple minutes, yeah. So first, before we jump, Ryan, appreciate you coming on and kind of sharing the State of the Union as well. I think this is very helpful to see how our preferred partners are managing through the economy that we've got going on and everything else. So we appreciate you coming on and just touching base with everybody. Let us know how things are steady as they go at Spartan these days, which is great. So thank you for that.
Yeah, you're welcome. Yeah, thanks for having me. Really appreciate the time to be able to talk through it. So
very good. All right. Well, with that, Ryan's going to join us for a little bit. You can feel free to jump over to wonder.me, and we could ask other questions as well. But thank you, everybody, for attending tonight.